I think from a short-term perspective, we're going to see gold moving lower because of what we see there. And then we're going to see at the later stage when I think the dollar is going to bottom out at around 90, 91, as I said. Well, then we're going to see a huge spike in the dollar, and that is going to cross gold and gold miners and the like. So I stand by my call. We're going to see a very strong decline in gold, but my structure tells me still that we need to see a lower low coming, and I may have said 890 to 960 or previously. I could see it go that low still, but I think there is also a case for around 1200. But either way, my focus here has been on actually getting into precious metals and miners.
Despite some support found on Friday, gold prices, as well as silver, concluded the week with significant declines. Both precious metals dropped to approximately 3-month lows in the previous session. The gold price has fluctuated recently as concerns about a potential recession have grown. While the price of gold rallied slightly, it still ended the week lower than previous weeks. The bond market is signaling recessionary risks, and the Federal Reserve is raising interest rates. While there are risks of a recession, some believe that the labor market and decreasing inflation may mitigate these risks. The performance of gold is often influenced by loose and accommodative policy responses during recessions, as seen in 1973, 2008, and 2020. It is expected that future U.S. recessions will also prompt accommodative policy responses, combining fiscal and monetary support due to high debt levels and the risk of a recession turning into a more severe economic downturn. Henrik Zeberg, the macroeconomist, in the interview with SOAR financially highlighted that the gold is often seen as a safe haven asset, but it can be sold off during recessions as people need cash. The price of gold may decline before rising again, so it's important to be cautious and not jump in too early. He suggests that gold serves as a means to obtain liquidity when it is scarce, indicating that it is not immune to market dynamics and can be sold off accordingly. The prices of gold and the dollar have a complex relationship that is influenced by a variety of factors, including investor sentiment, economic conditions, and the supply and demand for both assets. In general, gold and the dollar tend to move in opposite directions. However, there are also times when the prices of gold and the dollar move in the same direction. This can happen when there are major economic events that affect both assets, such as a recession or a war. Zeberg also highlights that the relationship between gold and the US dollar is not always consistent, as there are times when they move together and times when they move in opposite directions. Currently, there is a likelihood of a risk-on environment where investors favor higher-risk assets. In such an environment, defensive assets like gold may experience selling pressure. Let's hear from Henrik Zeberg interview. What is point of view?
When you get a recession and you start to see liquidity coming out of the system and the dollar is moving up strongly, you do not want to be in gold. And back in 2008, you saw a 36, 34% crash in gold over 6 months' time, from March of 2008 to I think it was September or something like that. And then you had the bottom. And I think people are just saying, yeah, you got to buy gold because you need to be, safe. But actually, gold is there to be sold off to get liquidity when none can be found. And if I'm right in the deflationary bust, then you're going to need liquidity in the system. And that's why gold will be sold off. But will it be a fantastic investment? Yes. But I just don't want to have 50% drawdown before I need to get into something that, of course, can go up. And I think gold will go to about 10,000 easily and higher. But just not now. And people have been calling for it. I mean, they have been evenly as wrong as I've been. I mean, I said it should be coming down earlier because I thought the bust were there. And I've heard 5,000 for a long time from the bulls also. And I just still. So what you'll see is that there will be certain amount of time, certain times where gold and dollar moves up together. And you'll see, of course, there's also the inverse relationship, but it's not like 100% at all. And you can have prolonged amount of time that where you could see that they actually move, in the same direction. So I again, this is about the number of variables that is between there are between every explain every asset that you need to explain, and here I think that we're going to see a risk on environment, which will be nothing like what we have seen in a long time. And I know people cannot comprehend that right now, but I think we're going to see an extreme risk on environment into this last blow off top, and that means that we're going to see when risk on is there, then you're going to see things that are more defensive being sold off. And I think that is where gold is going to suffer. So why do you want to sit with gold, which hasn't really moved a lot over the last couple of months here, a year or whatever? If you can get into Bitcoin that may go up, I don't know, 2 times, 3 times, maybe even 4 times perhaps, and other, risk assets, the small caps and the likes, as I see it. And it hasn't, passed by the two previous tops we had in, was it August of 2020? And I can't remember the next one, but there are three tops kind of. And I think you're going to see that it's going to come down from here. And especially at a later stage when the dollar is going to move up very strongly into deflationary bust, you do not want to be long gold in a deflationary bust. That's for certain. I mean, that's where everything will be sold off. And gold is not a, magic thing that will not be sold off. It's actually there to get liquidity when none can be found. And that's why I think it's going to be sold off again.
Zeberg expects that the inflation spike will result in a negative feedback loop, leading to a real recession that will likely occur in the first or second quarter of next year. The probability of a recession in the United States is increasing. A recent projection by the Federal Reserve Bank of New York estimates that there is a 70.85% chance of a recession by May 2024. Zeberg expresses that banks and other investments may perform better than gold in a risk-on environment. They believe that there could be a financial crisis developing at a later stage and that better investment opportunities may arise when gold and mining stocks are at lower prices. They point out that mining stocks are currently in a strong bear market and consider them to be leading indicators for the direction of the gold market. Gold is often seen as a valuable asset during equity market declines due to its reputation as a safe store of long-term value with minimal correlation to stock market factors. The recent turmoil in banks has reinforced investors' appreciation for physical gold, as it carries no counterparty risk compared to concerns about retrieving funds from collapsed banks. Let's listen to Henrik Zeberg's interview.
You will see kind of a slowdown after that. And the Fed is now hoping that they will not see that, with the crash of that. I think what we've seen this time around is that they created an artificial spike in inflation because they pulled this, the demand forward, but the supply chains were shut down, or at least, affected by the corona situation. And then you would have that these, the spike in living cost is going to create a negative feedback loop for now and until next year and year after. And this is what is going to cause the real recession, which will set in, as I said, in Q1 or Q2 next year. If you get into a risk on environment right now and you're going to see the banks are going to actually move higher, which is what I predict, well, then I don't think you want to hold gold. Do you want to hold it when you have a financial crisis that could be developing at a later stage? Maybe. And I also hold gold, of course. But I do expect the bigger, and a better investment will be at a stage where they are at much lower prices. And if you look at it, GDX, GDXJ, and the miners in general, you would look at them and then you can see that they are actually still in a very, very strong bear market, many of them. And that's because I think they kind of, set the direction for what is going to come for gold, because they will be leading gold. They lead gold to the downside, but they will also lead to the upside at a later stage. It's been a bull market ever since they started to print money. We just have to, look at it like that. So I think in terms of the structure, if I look at these from a the structural perspective and the model perspectives, then well, we are in a situation now where we're going to see the dollar, tumble even more, and I think we're going to see 90-ish, 91, 92, 93 maybe before we get to a bottom. It will not go in a straight line, but that's where we're going to end up, and that will be supportive of the risk assets of the equities and of crypto for a certain amount of time. And that is difficult to understand if you're saying gold is going. And remember, I am a gold bull also. I'm just saying I do not want to be at the wrong time. And I think that's where people get it wrong. I mean, for as long as the dollar is going, again, the dollar has an influence on gold, definitely. But if you are in a very, very strong risk on environment that I think we're in now, and later then will be transformed into something which will be a bust, that's not the good time for gold. That will be a time where you actually see, you had a strong bull market getting out from 1999 into 2011. And that was not, of course, you had the financial crisis where you actually saw a decline into the crisis, and then it came up strongly after. So you want to be in after the crisis. So when we see the crisis, when we see that, the flush of everything, then, after that, and the moment where the central banks will get back in again, and you'll see the stimulus coming out, then I think we got a whole new situation. And I actually think that the secular bull market that we had from 1999 until 2011, and then we have had a secular bear market until this year actually. I think we're going to see that bull market now continuing after that next bottom. But normally the bottoms are always defined by another low coming, and that's why I think we could see that coming into let's say early next year, because we're getting really close to that. And that again depends on when the recession sets in.
Gold prices fell nearly 1% on Friday, pushing its weekly loss over 2%. The decline was driven by hawkish moves from central banks, including the Bank of England and the Federal Reserve. Gold prices are tracking toward the 200-day simple moving average after retreating from the 100-day simple moving average. A break below the 200-day simple moving average could boost bearish sentiment. The relative strength index is also threatening the 30 oversold level. The best case scenario would be a quick rebound above the 100-day simple moving average. Fed Chair Jerome Powell reiterated his view that the central bank will need to raise interest rates at a careful pace to combat inflation. This sent bond yields higher, which is a headwind for gold prices. Before this week, there was a small chance that the Fed would cut rates later this year. However, markets now expect the first rate cut to occur in 2024. This could keep gold prices capped in the short term. That's all from us. If you like this video, please subscribe, like, and click the bell icon to be notified of future videos. We hope our content has helped you in your trading endeavors.